All right, so let me talk about leveraged investing. Real estate, when I purchased my real estate, I was still working and I was able to get a mortgage on my real estate. And when you do that, what happens is, let's say you, and I'm just making up numbers here. Let's let's say you bought a house for 130,000, which I have, and and I actually valuated it to replacement value was probably 250,000. So I knew I had bought something, a tangible asset that was appropriate value. But when you put a mortgage on it, you double the return for, in fact, sometimes you triple the return. So let me explain. If you took that 129,000 and had a paid cash for it, um, your return would only be about 10% if you had the normal rents and you had the normal taxes and insurance. But if you took a, say, 30-year mortgage, one, you're only using part of your capital, a much smaller part of your capital. So let's say you do 20% down and you have to do a few improvements on the property. So you may only have let me pause this. Okay, so it was a $129,000 house. 20% down would be 25,800. The reason why I did 20% down is because most lenders, if it's an investment property, you have to put 20% down. But the other thing is it puts you to the front of the line. The only people that can beat you out is cash investors. So leveraged investing is what Robert Kiyosaki talks about, and this is huge to consider this. And I highly recommend that you do it this way, because what happens is now I've only got $25,800 invested in the property, not counting some minuscule closing costs or something. So some improvements. Let's say you only got to slap some paint on the walls or something. You may only have $30,000 invested, but you immediately can bring in, let's say, 7,200 a year on that 32,000. So let's do, it's a 24% return on your money that year. So you're going to go from 10% to 24%. Now, if you have higher rents, you could do even better. But that's the point about leverage. Most people don't understand. It is a huge benefit. And by the way, that's before you do all the tax incentives that you get for depreciation, and then you'll get appreciation. So your returns actually can go up, 30, 50% or more, and that's what I've seen over time. So leverage on real estate is huge. Now the problem with most people is they'll end up start doing cash out to buy other properties, and you end up increasing your leverage, and that's when you get in trouble. So I've only chose to do the one level of leverage, except for some of my very early properties that I purchased. And I did like 15-year loans on them and things, because I got them such low valuations, and then I refinanced them to 30 and did cash out. So anyways, it ended up keeping them, not changing my profitability, excuse me, because the payments stayed the same. The biggest problem you end up when you start doing cash out, your payments increase and then your profitability drops. So I want you to be aware of that, because leverage is huge in tangible asset real estate investing. So I wanted to move to another form of leverage. And this is where gold is a store of value, and he talks about mining stocks. And this it's all about, when you buy things, you want to make sure you understand the valuations. And right now, gold mining stocks are very devalued. They're hated almost. Just like when I bought real estate, people the credit had tightened up and very few people could even buy. So we had all these foreclosures, short sales. The prices of the homes were half to a third of what the rebuild costs were. So he talks about. I did want to also say that there was an interesting note in here that gold coins are capital gains free, but silver has a value added tax, and he talks about, and this is in the UK, that you pay 20% more than the price of your coin. I almost wonder if that's a hidden tax we have in the States here on our silver. It's like a value added tax, or if it's just the fact we have so many people buying it, they've jacked the price up to increase their baseline. I'm gonna have to get some of these precious metals sellers on the phone, and we need to talk in depth about that to understand why silver is so high on the premium. All right, so anyways, the miners, we're actually almost at the mining cost for the price. So when you have a mining cost of $1,100 an ounce, and we're selling gold at, let's say the spot price is $1,300, that means they have a $200 per ounce. But if the gold price increases 20%, taking it to $1,560, and that's still short of the all-time high. So if their costs go up 10%, but if the price of gold goes up 20%, they're going to end up with a 75% increase in their profitability. And I've shown multiple times about these ETFs, these gold and silver ETFs. So like GDX is a large miner, and then you have GDXJ, junior miners, GOEX is explorers, and then you have royalties as well. If you put a little bit of money in these things, you can make a huge amount of return. Even though these are not necessarily tangible assets, they're ETFs, you can't ignore the fact of the leverage that these things employ, because of the fact that these prices are so beaten down, and it could be a huge windfall on the money that you invest in this. So I want you to be aware of that. This is a huge opportunity, and again, it's investing towards tangible, but you're using electronic means, which is what I have very little money in this anymore, but this is, again, buying low and selling high. I need you to think about that, because this is something that most people have not considered. The other thing, I wanted to go through a video about, this is Tyler has taken some of the things that I've already been showing you, that we're going into a recession. And you can see that this is the probability of a recession from the our central bank, and you can see that it's coming up pretty high now. And you can see where we were about this time for the last recession, and it was a little bit farther before we actually hit it, but the odds are coming up pretty fast. And then you can see that the yield inverted, and that's another sign right after that we're getting into recession. This is the interest rates hikes, and this is showing the failure of the central banks. They've got no more ammunition left, because they weren't able, each time they were only able to raise interest rates a little bit before it causes dire consequences to the economy. So we're on this declining trend, just nothing you can do about that. This talks about the balance sheet of the Fed. Each time they've done this to try to pull us out, we're just at unbelievable amount of trillions of dollars. And what they've done to the stock market, keep in mind these past history, I've shown you this before. I want you to be aware, where's this one going to go? Is it going to go 90%, half? We don't know. So this is the federal debt percent of GDP. I mean, the last time around we were at 60%. We're now like 120. Not good. Doesn't give them a lot of options here. Interest payments on the U.S. debt, this is the real problem. This is not going to be sustainable. And then the other thing, it's not just the U.S. All these other countries, their credit has gone off the chart compared to, we have this huge divergence from the GDP versus the credit. So this is going to be a worldwide phenomenon when this happens. So anyways, I just wanted you to be aware of that. I'm going to put the links to these articles so that you can look at them more carefully. I hope everybody's treating you well. I hope you're doing well. Do the best you can. God bless.